Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. We've had him on before. It's Dave Kranzler. He's a gold fund manager, and he has a new website. It used to be the Got Gold blog, but now he has an investment research dynamics website. And he also writes a lot of very good in-depth articles on Seeking Alpha, which is a good article for you investors out there who want to learn how to invest about the real estate market and gold and those types of things. So thank you for coming back on, Dave.
Oh, thanhanks for having me, Jason. Always a pleasure.
Yes, it's definitely always a pleasure. And you're also, besides in your bio for our listeners, Dave is a longtime Wall Street veteran. He worked as a bond trader, worked at Goldman Sachs for a number of years and some other top firms. Now, Dave, let's jump right in here and let's talk about the real estate market, because if you went and talked to people from the National Realtors Association or the people on CNBC or Bloomberg, they'll tell you the housing market's strong. What's your opinion on the real estate market?
Well, it's interesting you brought up the National Association of Realtors, because the existing home sales for March were out this morning, and it was actually a lot weaker than I thought they would end up reporting. And uncharacteristically, Lawrence Yun, who's the chief economist for the NAR, admitted, and I've never seen him admit this, he said that the market should be a lot stronger right now, given the level of population growth, et cetera, et cetera. So it was kind of, and I thought it was kind of a stunning admission by him, and I was kind of surprised to see that he put it in there. And he's kind of the king of spin and the king of hype, and it's always sunny out. Even when it's raining, it's always sunny out. So it's
about to be sunny.
Well, I don't think the sun ever goes in for him, but that showed that he's admitting now that there's some clouds on the horizon. But what was interesting to me about the data was that the sequential February to March showed a slight decline, which that shouldn't happen at this time of year. March should always be higher than February on a seasonal basis.
Because of the weather, right? Because when it's colder out, right, people are not going to go look for properties, especially here on the East Coast, right, or Midwest.
Well, it's just the way it works out. People want to buy their homes and move into them in the spring and by the middle of the summer, because they want to have a chance to work on them, get the gardens going, et cetera. It's just there's seasonality in there. It may partially have to do with the weather, although that wouldn't be as much of a factor in the West and the South, the South region. But at any rate, if they do what they do is they show seasonally adjusted annualized rates, which are it's their model for cleansing the data of seasonality, so that you can compare sales in July to sales in January, at least theoretically. But even on an adjusted basis, you'll still see slight seasonality. However, I actually went and looked back. I saw data that averaged out 2000 through 2011, and March is always higher than February, but not this year. March was lower than February. And then I went and I looked at the weather patterns that occurred across the country for March, and it was slightly below average in the Midwest, and it was colder than usual in the Northeast. The South was about average, maybe a little lower, and then the West was warmer than normal. However, every region showed declines, and the Midwest and the West showed double-digit declines, 10% and 13%. Respectively, and that's for year over year, so March 2013 to March 2014. The overall decline March last year to March this year was 7.5%. And then, like I said, if you break it down by region, some of the regions were worse. And the reason why the weather really isn't a factor is it wasn't as bad in March as it was in December, January, and February. And California this whole time has been warmer than average, and their sales are just getting hammered.
Now, why do you think that is? Do you think that the hedge funds who really in 2010 because they had such cheap money, artificially cheap money from the Fed, and they went and bought, some of these hedge funds bought, entire streets in Las Vegas and other areas, and Arizona and really depressed areas. Do you think they're starting to package these things up into real estate investment trusts and other things and dump these? Do you think that's why the real estate market is starting to slow down and or drop?
Well, they're trying to monetize their rental portfolios, their investment portfolios. They're not. I think maybe Blackstone might have gotten one bond deal off, one sort of pass-through bond deal. I'm not positive about that. I know they were working on one. And Colony Capital, who's probably the second or third largest buyer out there institutionally, tried to do an IPO last summer and they couldn't get it off. The market wouldn't take it. But what's happened now, and I suggested last year this would happen, it would be that at some point these big funds would be saturated and they would stop buying, and that's essentially what happened. And Blackstone has admitted twice now that their purchasing so far year to date is off overall about 90% from what it was last year. And part of it is there's definitely lower level of distressed inventory, although that's going to change in the next couple of years. But I think they've built up these massive rental portfolios, and I think they're having trouble renting, getting an acceptable rental yield on them. So the biggest
interesting, and their expertise is not doing these things, right? So they might not be hiring the right marketing people to do this. They're not experienced doing this. Their goal was to make capital gains off this, right? Not buy over the long term and increase their rents, renovate the property, things like that, like a good prudent real estate investor who invests for cash flow would. Their goal was to buy it low, right? And then hopefully the price of real estate would go up, 40 or 50% in 2 or 3 years, repackage it, and then dump it back on the market. That was probably the goal for these banks, right?
Well, I think part of it was what what you're talking about. Part of it was I think they have all this cash to invest, and they're not going to invest it in treasury bonds that are yielding next to nothing, and even junk paper is yielding
4%, right, or 5% average, right, which is
depending on the rating.
Low, right?
Yeah, I mean, triple C paper, which when I was trading junk bonds would yield anywhere from 10% to 20%. Triple C paper now is 4 or 5%. It's not worth the risk. So what they were doing is they're putting capital to work, and their spreadsheet models were showing that they could get a 6% cash-on-cash return by buying up cheap real estate and renting it out. Well, they're finding out they're not getting those returns for a lot of reasons. And I also think that the market for renting homes isn't as strong as people envisioned it would be, especially now. Over the last 18 months or so, you've seen just a boatload of multifamily structures that were started and have come online. They're all over Denver, brand new apartment buildings. And that creates a serious source of competition for outfits that are trying to rent out homes.
Yeah, the building everywhere is enormous. Like I as you know, I live outside the Washington, D.C. metro area. And really for the last 4 or 5 years, there was a break, obviously, during 2007, 2008, a construction break, because even the D.C. metro area, which is normally like a really great real estate area, it normally doesn't have any problems, but even then it had a slump. But it seems like within, year and a half or so after the crash there, they were back to massively rebuilding again. And there's an enormous, amount of new properties. They're knocking down old buildings. They're knocking down, strip malls and putting up right outside of Washington, D.C., like these enormous condo towers and stuff like that are going to cost like over $500,000 just for a studio or a one-bedroom apartment that no one in my age demographic, Generation X, Generation Y, the millennials can afford, because we don't have any savings. We have student loan debt, and most of us are lucky enough to get our first job or second job or something, we're only going to be making $30,000 to $50,000 a year, and we have all these other bills. It's going to be near impossible to afford a place like that. Is that what the Denver market is looking like too?
Well, that what you just described, that's a national phenomenon, and you're seeing that in the numbers. I mean, the first time, basically the demographic you described is what's known as the first-time buyer, and historically the first-time buyer is 40% of home sales. And as of the latest existing home sales report, the first-time home buyer was 30% of the home sales, and it's been as low as 26-27%. So you're talking about, the bread and butter of the housing market is dwindling, is dying on a vine, and their demand component is decreasing. So if you pull away the demand that we've seen from the large investors,
that makes perfect sense, right?
Oh yeah, if you pull away the demand,
how the real economy is acting, right? Yeah.
Absolutely. I mean, the housing bulls think that we're in this cycle where somehow magically demand is going to appear out of nowhere. But if you look at the underlying variables of what drives demand, a big component of it is income.
Well,
and you're seeing the median household income has been declining, as has been the real disposable income, especially for the demographic represented by your first-time buyer. I mean, after when their weekly take-home after taxes and necessities, gas, food, medical bills, etc., they don't have money left over to support buying a home.
Yeah, I mean, a lot of I talk with a lot of people locally around here. I just ask them, or some of them like even tell me like out of blue, they're willing to talk about it. They're not doing that well, Dave. So there's people that are working, one job, two job, three. They're working a full-time job and two part-time jobs just to pay their rent and food bill in my age demographic. And this is one of the lowest unemployment areas in the whole country. So these people can barely afford their rent and their food, and they're not going to be able to buy a home because, right, if the real economy was doing that well, there would be wage growth, there would be savings. My demographic would be able to put 20% down. We'd have $40,000 or $50,000 in the bank, a good stable, $60,000 or $70,000 job, and not too much debt. And that's definitely not the case. There's not a lot of the demand, I think, for the real estate market has been, artificially caused by the Fed and artificial interest rates because it's pushed people, away from money market funds and bonds, like you said. But here in the D.C. metro area, I don't know about your area, but there's an enormous amount of flight capital. And Wall Street for Main Street has real estate contacts not only in the D.C. area. I'm friends with real estate agents in this area, but we have friends also who message us from California and stuff like that. There is an enormous amount of foreign buyers, people who are leaving China or Europe or England and stuff, and they're willing to pay all cash for, single-family homes and condos and things like this. I guess maybe they're worried that the shit is going to hit the fan in China, and they're moving money out very rapidly. And
actually, the latest data shows that ship has sailed, especially the Chinese buyers. Their economy is starting to decrease pretty rapidly, and you've had the yuan has had a massive decline against the dollar, and so what these foreign buyers the foreign buyers aren't pouring capital into the housing market like they were, say, from 2010 to 2013. So that's gone. A guy in China is not going to buy an average home over here unless he's going to come over here and live. And you're just not seeing that. So
okay, because from 2010 to 2013, like you were saying, there was people who would literally, hop on a flight from China to, California, Irvine, or Washington, D.C. metro area, and within a week they would have paid all cash for,
that's right, but they were doing that to
hop right
show,
back on the plane.
That's right, but they were doing that to hide money, et cetera, and launder money, and a lot of that buying was for the big trophy homes. And like I said, that ship has sailed. That's not what's going to drive the real estate market. What drives the real estate market is your average American buying a home from a move-up buyer who goes and buys, a move-up home.
New wife pressures them into
so when you pull the first-time buyer out of the equation, the move-up buyer is frozen because who's he going to sell his house to? You got to sell a house to buy a house. So then then you slow down the move-up buyer. You take the investment buyer out of the equation, and you've got a recipe for a real disaster in the housing market. And especially since I follow the home builders as kind of an avocation, and for the last 18 months, they've been borrowing money and plowing it into inventory. And what I think is going to happen, because you're also seeing new home sales decline the same way existing home sales are, what I think is going to happen is just like it happened in 05, 06, 07, these home builders are going to have plowed all their capital into inventory, and they're not going to have anyone to sell it to. So we're going to, we'll have a repeat of what we saw that really started in the middle of 2005.
That's very interesting. And you think then that the home data, because most of the growth that the nominal GDP claims, right, from the United States from really 1999 onwards was all housing market, right?
Well, a lot of it was housing. I mean, it was all sort of lumped into the consumer.
Okay.
And you're seeing all kinds of signals that the consumer's done. I mean, the retail sales numbers are terrible.
I agree with that. Yep.
Auto sales, they're being fueled by subprime loans, and those are going to start tailing off soon, just like we're seeing housing tail off. So,
well, not if the auto companies, Dave, can keep issuing these basically subprime loans. I think GM stopped even reporting the FICO credit scores of the people they give out these auto loans to. And some of these their fastest growing auto loan market is the subprime market. It's growing like over 10% per year here in the United States. And like some of these loans are like 96 months, no interest for 2 years, and no money down in order.
I understand that, but that doesn't mean that they're not going to default on that paper. And you do saturate the subprime borrower market at a point. We saw that with the housing market bubble. You saturated, there's only so many people that you can give a loan to who can fog a mirror. After that, you got to start trying to give loans to people in graves. So we will, and in terms of why GM is basically giving auto loans to anyone who can fog a mirror. Well, the government's trying to unload the rest of its Ally Financial, which is the old GMAC. They're trying to unload the rest of their Ally Financial stocks. So they need the numbers to look good.
And they dumped their General Motors stock too.
Well, it's
and
just
they knew about the recall supposedly too before anyone else.
Think about it, Jason. The government dumped their GM stock in December, and the recall stuff hits the news wires about 2 months later. There's no way the government didn't not know about the recall situation, and they covered it up so that they could get rid of the rest of their stock.
I agree. Yep.
And you're probably going to see the same thing with Ally Financial. They're trying to load the pipeline up with subprime paper so they can have good-looking origination numbers and origination numbers that show a good growth trend. And then once the government's done, you probably see the subprime auto paper starting to have problems. You're already seeing delinquency rates ratchet up quite a bit in subprime auto paper.
That's a very good point, and I think you brought up to our listeners here some possible shorting ideas down the road. I know for a fact, too, because Porter Stansberry spends a lot of time on GM, and he also called their bankruptcy years in advance, that he says GM is massively channel stuffing, and, their car sales have really just been, dumping inventory onto their distributors. So
well, they are channel stuffing. I also happen to cover. I follow the auto sector just again as an intellectual interest, because it's supposed to be, your legs of your traditional legs of the economy are housing, autos, and government spending. It's kind of the three legs of the economy. And I actually said when GM reissued their shares to the public, I said, we're going to see a Chapter 22 out of this, because that company still has a lot of problems. And so I actually reported on a lot of the data. I saw his most recent report, and I reported a lot of the data in a Seeking Alpha article before his report came out. I was glad to see his report because it confirmed the data that I had sourced and the conclusions that I had drawn from it, which is, GM eventually is going to head south again. In fact, I recommended shorting GM, I want to say last October or November, when the stock was around 41. Now, I got a little bit lucky in the timing in terms of that recall stuff coming out, because that's helped hammer the stock. But to make money shorting any stock in this stock market is heroic. And
because the governments aren't allowing it, right? It's no free markets, right?
Right, exactly. I mean, look at what the S&P's done. I mean, GM stock is down quite a bit percentage-wise since I recommended shorting it, with the S&P up close to like 15% in the same time frame. So, it's a tough market to short stock. So if you can find a stock,
especially when they can change the rules, right? Because you have these European banks which are all a disaster. Right? Deutsche Bank is a total disaster, but I think they outlawed you can't short European banks in Europe. So the governments are going to keep changing the rules. The banks or the home builders, they may crash, but then we could see the governments come and say, oh, you can't short home builders or something like this. We don't know what's going to happen, all the crazy rules that the government's going to keep coming up with.
Yep, that's true.
Okay, well, I think you did a great job talking about the real estate market for our listeners, and also maybe what's going on in the real economy with the consumer. Let's transition then to gold, because you run a gold fund and you look at these things. Talk about how and why Wall Street gold analysts don't mention I think the most important part of physical gold demand, Chinese physical gold demand at all, and can't account for it properly like Cruz Gensidov and Gold We Trust. Because there's all these research reports coming out from Wall Street. It's basically when gold was about to break out, I think around 1400, and then you just saw even more of these research reports like what came out in April of last year before the huge takedown, saying how the Wall Street analysts are expecting gold to go back down to 1,000 and stuff like that.
Well, my opinion of Wall Street analysts who cover the precious metal sector is that I like to call it Wall Street's pro bono hiring segment of the market, because it seems like the analysts that they hire probably have trouble tying their own shoes, let alone analyzing any specific market. I mean, it's embarrassing. But Wall Street can't make money on the precious metal sector, so they're not going to invest money in it, getting good personnel and good analysts. There just isn't. There's maybe some M&A deals, an occasional bond deal from Newmont or Barrick, but there's not a lot of money to be made on the precious metals. So Wall Street, of course, is going to be anti-precious metals, whether precious metals make sense or not from a fundamental standpoint. In terms of the coverage of the physical demand situation over in China, I mean, it's surprising that Wall Street even really acknowledges it, because they don't really. All Wall Street analysts do is they take the World Gold Council numbers and regurgitate them, and the World Gold Council doesn't really acknowledge accurately China's demand numbers. So if the World Gold Council isn't going to report accurately on it, since most Wall Street analysts just regurgitate what they're told from quote-unquote authorities anyway, the Wall Street analysts aren't going to get it right. There is one Wall Street group, it's out of London, it's the UBS Metals Group out of London, and they're probably the best metals group of any investment bank. Not that really is a compliment for the UBS Metals Group, but they do maybe get about 50% of the story right. And even they whiff on acknowledging the differentiation between the enormous demand in the physical market versus the manipulation that's going on in the paper market. And I'm sure all these, even the analysts that may know about the manipulation, I'm sure they're under explicit marching orders not to talk about the manipulation.
Yeah, they're definitely not allowed to talk about the manipulation, because we've had on Michael Krieger, who was a commodities analyst too, and he wasn't covering gold, but anytime he wrote about gold or manipulation and stuff like that, he was told not to when he worked on Wall Street as a commodities analyst, and he was offered promotions and all these other things to stop writing about it and talk about it and things like that. And I think that's par for the course, you're not allowed to, if you work on Wall Street, objectively look at that market and see things like that. Because, Wall Street, you said Wall Street doesn't make money on gold, so they don't make money on the long side, except what they did with the arbitrage, when they could liquidate GLD and sell it, into Asia for big premiums. That was
I think they were proactively smuggling it into India and selling it for an even bigger premium.
You think so?
Yep.
Oh, really?
And I
Wow.
we subscribe to a very, very expensive 3 times daily gold market report. It's written by a guy named John Brimlow, and he comes up with data and has contacts that are not available to me. Otherwise, I wouldn't pay for his service. But it's a great research service, and he pretty much confirmed my hunch about that. I mean, HSB and UBS are no doubt, and probably Goldman Sachs are taking. Well, we're taking gold out of GLD, and I think they needed a lot of it to deliver into Asia, into China. But I think they were also taking some of that gold out of GLD at the spot rate and flipping it into China when the premiums over there were $135 over spot.
Yeah, so they were making money shorting the paper price, and then on the long side, they were making money with the physical metal, like selling it, liquidating the GLD, selling it into China, and then doing what you just said. So they're making money all these different ways, and yet look at what happened with the paper price the last, 18 months. It's just amazing. The average person who doesn't look at the details like you and me would say, this is a total bear market, gold's never going to go up again, blah, blah, blah. They're gonna, because there's the mainstream media almost never has anything good to say about gold or silver, but the research is just horrible, or it's either horrible, it's either intentionally stupid or intentionally lying, or a combination of both. That's the way I view.
I think it's a combination of both.
Yeah. Now, let's talk about the miners, since I think you've updated us here on the gold market here. You expect demand to stay pretty strong then out of India and China then for gold or silver?
China's going to pick up, because once their election process is over, you're probably going to see a new government in there that's going to remove the import controls on gold.
That's an interesting catalyst.
So India is probably going to pick. India's already picked up. They've already slightly eased some of the restrictions in terms of importing gold into India, but the existing government's probably going to lose their job because of the gold import restrictions. So once those are removed, it'll probably happen right before India's largest buying season starts, which is starts around mid to late August. And that's exactly when the import controls were implemented last year, right before their largest buying season. I actually think if those import controls weren't put in place, we probably would have seen some big physical gold defaults last year.
Yeah, and there was also the unintended consequence, too, of what India did, how it created enormous demand for physical silver. I think physical silver demand exploded in India to an enormous amount not seen in many years. And then, you have the smuggling market, because people still wanted gold, so they're willing to pay those premiums in a black market, right? So even if the government says, you're going to have to pay these import duties, or they go to the jewelers, the main large jewelers, through the normal, legal, conventional ways, and they try to shut down the airports, people are going to swallow gold, right, and smuggle it in, or people are going to recast gold bars, right, in the form of a TV, paint it black, right, and try to smuggle it in from Pakistan or Dubai or something through trucks, or they're going to sneak it on the airplane, right? They're going to come up with clever ways to make that extra money, because, the government cannot completely stop the will of the people. They can't stop market psychology, even though it seems here in the West that the government, Wall Street, Keynesian economics, and the government have done a really good job with psychological controls for keeping most of the people away from wanting to buy any gold or silver.
Jason, there was a quote from an article that was linked in Brimlow's early morning report today. It was quoting the chairman of the All India Gems and Jewelry Trade Federation, and his quote was that there's been more gold smuggled into India in the past 4 months than in the previous 10 years.
Wow.
So that tells you what the situation is. And as you pointed out, the unintended consequence was India imported an enormous amount of silver over the last year. And I actually think, even though you're not reading about it and you're not seeing it in the COMEX numbers, I actually think there's probably a silver supply problem over in Europe. And I know James Turk did an interview last week where he mentioned that the physical silver bar market on the LBMA is in backwardation, and which tells you there's a shortage of silver bars. So,
I don't know where China sources all of its silver from, but I think I told this before I started recording. Keith Neumeyer is the CEO of First Majestic Silver. He did an interview a couple months ago talking about how there was a very large factory in China that handles electronics, and they couldn't source any physical silver for at least a week or two, and they had to shut down. And Keith Neumeyer is one of the top CEOs in the entire silver mining, gold mining industry, and he was just frustrated that that didn't affect the price at all because, I mean, at some point, right, we have to get back to reality. We have to get back to supply and demand, right?
That's right. Well, I know Ted Butler, and I don't agree with everything Ted Butler says, but I don't know if you've noticed, but the Mint has been selling an enormous amount of Silver Eagles this year. And if you strip out the initial surge in Silver Eagle sales last year that there was a shortage of Silver Eagles at the end of 2012. And so they just shut down production, and there was a huge spike in Silver Eagle sales at the beginning of January last year, 2013. If you normalize that out, the sales rate of Silver Eagles this year to date, is significantly higher than the year to date level of 2013, and 2013 was a record year for Silver Eagles. Now, Butler thinks that a lot of that demand for Silver Eagles is coming from foreign buyers, and there's no way to prove that, and I don't know that I necessarily agree, but I don't necessarily disagree with that. And it could be people who need silver over there. They buy the Silver Eagles here and recast them into the form that they need them in over there.
Well, I have some friends in the bullion contacts thing, and they tell me there's not a lot of retail buyers who have started buying, things like large order Silver Eagles again. So maybe it could be partially, these guys who are stocking up in the numismatics for the PS70s, because that's a large pre-order, right, of the Silver Eagles every year. But yeah, it could be, foreign buyers from Asia or foreign buyers from the Middle East, a lot of energy and oil money, who are trying to cleverly figure out ways to, hide their purchasing and things like this through, different agents and things like that.
Yeah, it's hard to say for sure. I just know the Mint selling a lot of Silver Eagles, more than they were last year.
But the U.S. consumer doesn't seem, aside from gold or silver bugs, only the really hardcore people are still in the market really buying physical, right, at this point. At least that's what my bullion dealer contacts tell me.
I think that's right. I mean, the average consumer, again, doesn't have a lot of disposable income to be throwing at
and
silver
they got
and gold
killed
bullion.
They got killed too because they chased it up, in 2011, and they didn't, they're not disciplined long-term buyers. They're not going to buy it on dips or when the price is dropping. They're just not going to do that.
That's right.
Well, most people anyway. Okay, so I think we addressed gold, silver supply, and demand pretty well. Let's transition now to the gold stocks. So the gold and silver stocks, we've had a pretty nice rally here for 2014, nice little bounce, because I guess that was a good relief rally compared to how bad things were, for the last couple of years. But we're still not seeing a lot of profitability at the companies really, other than the royalty and streaming companies. Do you think that it's smart then for these large companies like Newmont and Barrick to be discussing mergers? Because I don't think it's smart at all, and I think it disgusts me.
To be honest, I kind of stopped following the very large miners. They're run like government bureaucracies. They're mismanaged. They are depleting their resource base. I mean, even Gold Corp, which up through the time that Rob McEwen was running the company, was an extraordinarily well-run company for a large company. And it seems like ever since then they've just made misstep after misstep. Gold Corp was the only large cap company up until a couple of years ago that was replacing its reserves more quickly than it was depleting them. And I'm not sure that that's the case with Gold Corp anymore. And they've overpaid for acquisitions in the past.
Everyone in the industry is basically overpaid.
Yeah, the Gold Corp paid something like $1,200 an ounce for an acquisition. I think it was in 2010, and that's when I was like, ugh, I'm done with the large caps. So I don't really follow the large caps. I know Newmont and Barrick we're discussing a merger. I think they may have called it off for now.
Yeah. Because too many people were laughing.
I don't know why that would make sense. I mean, toxicity plus toxicity does not equal purification, and they're both two extremely toxic companies.
And they're just too big in mining too. I mean, how big a deposits, the grades they're going to have to go after. The capex has been such a disaster for these large companies. The capex overruns, the cost overruns, the grades have been dropping.
Right, like I said, they're all run like government entities. They're terrible. They're big fat bureaucrats, and the upper level executives manage the companies to maximize their stock option compensation. So what I did about 18 months ago is I started shifting out of any of our larger cap exposure. I think Agnico might have been the last large cap that we owned in the fund, and I started shifting the capital that we allocate to the mining stocks into select juniors, and we've got one, what I would sort of call, it's not an intermediate producer. Actually, we do have an intermediate producer because I put Golden Star in there about a month ago. When the correction or the sell-off in the miners started again, I started accumulating some Golden Star because I think it's just too cheap not to accumulate. And that management's actually been doing a good job running Golden Star, but it's not a large cap. It's at best an intermediate producer. But we're largely concentrated and focused on the juniors, and because that's where I think the best bang for the buck's going to be when this market takes off again. The
junior producers who have a resource in an I-43-101, they've drilled it out pre-feasibility, or are you talking like the explorers? Because
well, I mean, it depends on, again, it's gray area how the lines of demarcation between explorer and junior. I mean, if a company is poking holes in the ground, and even if they have a 43-101, in my mind, it's still a junior. It's still an explorer. So let's just say, the pre-production companies, the companies that have approved resource in the ground, that have at least a year's worth of cash on the balance sheet. Ideally, management owns at least 10% of the equity, although that's not a hard and fast rule with me. That's what I like to see. Some of our companies we're invested in, management owns 30% of the company. And ideally, I want to see a 10% foothold or thereabouts by a large cap company, because to me that's one of the potential exit strategies is to flip it into the guy who owns 10% of your shares, who's got a lot of money. So, but yeah, it's basically what I focus on right now, where I think you're going to see the potential for 10 to 20 baggers if you pick the right ones, is in that area where you've got a resource, maybe they're working on a pre-feasibility study, et cetera. One that we own, Almaden Minerals, just released a pre-feasibility study, and it shows just on their one project, their gold mine project down in Mexico, it shows a net present value of $728 million. Now that assumes 13.20 gold, I believe, and $21 silver, which we're going to get back to eventually anyway. But the market cap of the stock's only $88 million. So to me, that tells me there's incredible value there, and that's the type of opportunities that I like to focus on and I try to find.
Yeah, that's interesting with Almaden, although Almaden's a prospect generator, right? So they'll probably flip that property then to someone else, and then they'll issue a special dividend, right? Because Almaden doesn't really develop things on their own, right? They're more like they drill the thing. They look for very highly prospective targets. They usually use other people's money, right? Larger miners to finance some of their drilling, and then they find a nice resource, and then they either ride for free on a JV deal or they sell the whole property for a huge return to their cashing out, and then they pay special dividends.
Well, they haven't really run through the cycle of that model yet. I mean, they do use the word prospect generator in reference to what they do, but really what they do is they go out and they try to find evergreen situations where they're going to be the first ones to drill there, and then they drill it out. They've done it with some much smaller properties where they've drilled it out and then sold it to a bigger company in exchange for net smelter agreements, net smelter royalty agreements. But that side of the business model isn't really producing cash yet, because I don't believe that anything that they've run through that cycle on is yet a producing mine. But this mine down in Mexico could turn out to be, a 5 million ounce deposit, and that's the type of deposit that the big guys like Newmont want to see before they go in. Newmont could just go in and swallow up all of it, and that's a possibility. And they also started drilling out another property down there that they think has the possibility of being a giant gold copper porphyry. The type that you find in Chile. All the indications are, they haven't been able to prove it yet, but the indications are that there's that possibility. And that's if that's the case with the property that they're starting to, this new property they're starting to explore, that's a game changer if that's what it turns out to be that they're sitting on. I mean, then that's the type of thing that turns this stock into a 10 or 20 bagger.
Very good. And for listeners out there, also, do you think a lot of the junior in your portfolio, then you've stress tested them for cash and other things, and done research that they have low enough cost projections, or they're producing now and their costs are low enough? You think that they can survive a gold price if we temporarily drop back down to maybe $1,250 gold or $1,200 gold, or maybe even $1,180 for a very temporary time before the market starts going higher, probably by the end of the year?
I don't own one junior miner in our portfolio that, regardless of what the gold price does, will need to raise cash in the next year. And some of them have enough cash for as long as they want to have it. For instance, Exeter Resources, if they want to, they can slow down their CapEx spending so that they have 6 years worth of cash on their balance sheet. I mean, their shares trade almost at their cash per share level. Wow. Another one is Rye Patch Gold.
That's a lot of optionality.
Absolutely. And another one is Rye Patch Gold, which you may or may not be familiar with, but they just did a big lawsuit settlement with Coeur d'Alene. It was a kind of a complicated dispute, but it turned out they as part of the settlement, they got $10 million in cash, and they had $1 million in legal fees, so they netted $9 million in cash. Plus, they ended up with a net smelter royalty agreement on a mine that's in Nevada that is producing a lot of silver, and that's throwing off more than enough cash flow per year to cover their CapEx expenses. And that thing goes, I want to say 6 years, but I don't remember quite how long it goes off the top of my head. But it's examples like that where you find these companies that have. There's not plenty of them, but they're out there that have plenty of cash, regardless of what the price of gold does, say, over the next 6 months.
Yeah, and I think this gold and silver mining industry is one of the few industries left in the stock market where there's, absolute screaming bargains, where you can buy stocks very close to, the total cash per share in terms of the market cap. So you get humongous upside. You can either buy it for around book value or lower than book value in some cases. It's pretty crazy there that, the reserve value.
I'll just throw two more metrics out there. In relationship to the price of gold and in relationship to the level of the S&P 500, the Huey index is is as low as it's been since 2000.
And there's not many industries that can say that, with the Fed and other global central banks just, creating enormous asset price inflation.
I don't think there's any. What it tells you is that the mining shares represent basically unique historical value right now.
But the problem is most value investors don't like resource stocks. So that's
maybe that
offers a concern. Yeah, exactly. I'm not the normal, Warren Buffett value investor. So I do like Warren Buffett's, analysis on value stocks and Benjamin Graham and that stuff. But I'm willing to look in the resource sector for value. I've made good money in the past on resource stocks. I bought after the 2008 market crash. I bought a lot of mining stocks and made good money for a number of years. I did sell out some profits. In 2011, I didn't take enough profits, and I bought back a little too soon for some of them. But, it is what it is, and I'm still learning. I'm only 31 years old, and I'm making mistakes, but I think I'm getting better. Dave, in wrapping up this interview, let's talk about your gold fund then. If I'm a SEC accredited investor, or I have, $100,000, I have a good amount of physical gold or physical silver already, and, I want to try to make that next leap and try to become a multimillionaire. How would I put my money into your fund then?
Like you said, it's a 144A accredited investor fund, and the website link to our company is goldenreturnscapital.com. And the regulators made us password protected because they considered it marketing that we have the website. But if you go to goldenreturns.com, there's a link on there where you can get in touch with my partner who will set you up with a temporary password. But it's basically, we operate it like a small hedge fund. And we do buy physical gold and silver bullion, primarily 1 ounce bullion coins that we keep in a private depository in Delaware that's not associated with the COMEX. And then we put the other half of the fund in aggressively invested in junior mining shares.
Very good. And I was actually going to ask if the fund has physical bullion, because some people, just don't want all of their money in mining stocks, because there's just too many people out there that, check their account value every day. And with one thing with the mining stocks is the volatility. There's just enormous volatility swings that even a good amount of professionals can't handle.
No, it's incredibly volatile. In fact, the reason why we buy primarily 1 ounce gold and silver bullion coins, the Eagles, Maple Leafs, Philharmonics, is we offer our investors the option of receiving a pro rata share of their cash out proceeds when they redeem their investment. They can actually receive part of their redemption in physical gold and silver. We'll have it delivered to wherever they want to have it delivered to. So it kind of makes our fund somewhat unique.
That's great. Now, thank you for your time, Dave, and please tell listeners the websites where they can find your articles. You have a new website, so our investors who went to your old one, the truthandgold.blogspot, that website, is that still up and it's going to be taken down, or is that one already down?
It's still up, and there's a link to my new website. It's called Investment Research Dynamics, and as soon as I get some more content produced, and as soon as my web guy gets around to it, I'm also going to offer mining stock research reports for sale for a small fee. And at some point, I may actually try and roll out a newsletter, an investment newsletter type service.
Well, maybe you'll repost some of these Wall Street for Main Street podcasts, and not to toot my own horn, but
no, I'll absolutely post them.
Great, Dave. So keep up the great work, and I think this is a good time for people. Maybe in the short term, gold's going to go down a little bit and retest, some support. But I think I already said this at the beginning of the year. I think by the end of the year we'll be higher. We might even touch 1525. We could have a pretty big move by the end of the year before we have a nice correction again.
Yeah, I agree with that.
Okay, well, thank you for your time, Dave, and we'll have you back on again soon.
Nice talking with you, Jason.